Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to take a close look at Nvidia's cash flow and explore whether it's as solid as it seems or if there are underlying risks that could make it unstable. We'll examine key financial details, trends, and factors that impact cash flow to get a clear picture of the company's financial health. Let's get started. Nvidia is a remarkable company, and its success in the AI era is often seen as unstoppable because demand for accelerated computing is rapidly growing, and Nvidia stands as the main supplier. However, the strength of its cash flow relies heavily on just a few major customers. Nvidia itself has acknowledged that a significant portion of its revenue comes from a limited number of buyers, and this pattern is expected to continue. In fact, in one quarter, two customers alone made up 39% of total revenue, with one accounting for 23% and the other for 16%. Additionally, large cloud service providers contributed about half of the revenue from Nvidia's data center segment, which itself made up 88% of overall revenue that quarter. While the market views this concentration as a sign of scale, it also means Nvidia is quite dependent on those few customers. This dependency makes the cash flow less stable, more like a tall structure that looks strong but could be vulnerable if key customers shift their business elsewhere. Nvidia's cash flow isn't coming from a wide range of customers, but is heavily weighted towards a few very large buyers, mainly hyperscalers. The company's filings show that a significant portion of their sales is to a small number of direct customers, like OEMs and system integrators, who then sell to big end users such as cloud providers. For instance, in one quarter, just two customers accounted for nearly 40% of Nvidia's revenue. This setup makes it hard to know exactly who the final customers are, but increases the risk because so much demand relies on a handful of major players investing heavily in their infrastructure. Nvidia itself points out that large cloud providers make up about half of its data center revenue, which is its biggest business segment. This means the cash flow isn't diversified. Instead, it's concentrated in a narrow group whose continued spending is crucial for Nvidia's revenue stability. Unlike a typical consumer brand that can easily replace a retailer if lost, Nvidia operates in a very different environment. Its main customers are the hyperscalers like Microsoft, Amazon, Google, and Meta, who hold significant power. These customers aren't just buyers. They negotiate pricing with considerable leverage, influence Nvidia's product development by requesting custom solutions, and even have the potential to create their own alternatives if they choose to. Additionally, they control capital spending and can quickly reduce purchases if the return on investment doesn't meet expectations. Because only a few companies control such a large share of Nvidia's revenue, the stability of Nvidia's cash flow depends heavily on their continued purchasing at current levels. This concentration creates vulnerability that's quite different from a business with a broad, diversified customer base. Nvidia's own disclosures about periods of heavy reliance on a few customers highlight this risk clearly. Concentrated cash flow means the company's financial health is fragile and highly sensitive to changes in its top customers' behavior. Hyperscalers like Microsoft, Google, Amazon, and Meta are actively shifting their approach by developing their own custom chips instead of relying solely on Nvidia GPUs. Microsoft has introduced Maya 200, a custom AI accelerator already being used in their data centers and for internal projects. Google continues to expand its TPU lineup with the 7th generation Ironwood, offering an alternative to Nvidia chips. Amazon is investing in its own Trainium and Inferentia chips tailored for AI training and inference, marketing these as their proprietary solutions. Meta is also building custom silicon focused on improving compute efficiency and cost. This reveals an important strategic trend. The biggest buyers of Nvidia hardware are simultaneously working to reduce their dependence on Nvidia by creating their own alternatives, which could challenge Nvidia's concentrated cash flow over time. When just two customers account for nearly 40% of revenue in a quarter, it sets up a stress test scenario for Nvidia. If one of these customers or the end users they serve slows their purchases because of capital expenditure pauses, shifts toward using internal silicon for inference tasks, delays in product generation cycles, or a decrease in model demand growth, the impact isn't small or linear. Instead of losing a small portion of revenue, Nvidia risks losing a significant chunk of the growth that investors expect. This can quickly change how the market views Nvidia, from a high growth leader to a more cyclical supplier, which squeezes valuation and tightens expectations around cash flow. On another front, Microsoft's Maia 200 chip highlights a strategic move focused on inference acceleration, which has a big effect on long-term economics since serving AI tokens at scale is costly. Hyperscalers like Microsoft may stick with Nvidia chips for cutting-edge training clusters, but at the same time, they're increasingly using their own silicon for large-scale inference to cut costs. If this substitution speeds up, Nvidia's unit sales might look strong, but the company's cash flow and pricing strength could weaken because these higher margin inference workloads are moving in-house. This combination of concentrated revenue risk and evolving customer strategies shows how fragile Nvidia's cash flow position can be despite its current strength. Google is not just creating standalone chips, it's building a whole platform around those chips. The Ironwood system, for example, is designed to scale up to large configurations like pods or superpods, focusing on performance and efficiency for AI inference at the system level. This means the real competition isn't just a chip versus a chip, but entire ecosystems competing against each other. Since Google can offer its TPUs as cloud resources, it turns its internal chip development into a commercial advantage, attracting AI workloads towards TPU-optimized environments instead of Nvidia's. AWS follows a similar path with its Inferentia and Trainium chips. AWS positions Inferentia as a cost-effective option for AI inference within its cloud, aiming to capture a significant share by providing a smooth, affordable migration for customers already using AWS services. In this way, AWS only needs its chips to be good enough, not necessarily better than Nvidia's, to weaken Nvidia's pricing power. Finally, Meta uses its MTIA chips to improve efficiency and customize hardware for its specific AI needs. At Meta's scale, even small efficiency gains translate into huge cost savings, making the decision to build custom chips more economically sensible than buying from external suppliers. Together, these examples show how hyperscalers leverage scale, integration, and ecosystem strategy to reduce dependence on Nvidia, gradually shifting AI workloads toward their own hardware solutions. One of the main risks here is how hyperscalers, which are Nvidia's largest customers, don't spend steadily, but instead in cycles. They go through phases of rapid build-outs, then pauses, followed by re-accelerations, creating what's known as air pockets in demand. Because the bulk of Nvidia's data center revenue depends heavily on a few big cloud providers, any synchronized pause in their spending can lead to a sudden sharp drop in Nvidia's cash flow rather than a gradual decline. Another key risk is the growing push from these hyperscalers to develop their own internal silicon solutions. Microsoft's Maia 200, Google's Ironwood TPU, and AWS's Inferentia and Trainium chips are designed to reduce reliance on Nvidia products. While Nvidia won't necessarily become irrelevant, this shift means Nvidia could lose volume on less demanding workloads, which reduces its pricing power and margin stability. The result is a cash flow stream that becomes less stable and predictable because Nvidia holds the premium segment but at a smaller scale, making the financial outlook more fragile. Large customers have significant leverage. They can push for better pricing, control over supply commitments, priority when stocks are limited, and even demand products tailored specifically to their needs. When a supplier relies heavily on a few big buyers, they often invest in advance to meet these demands. But if those customers reduce their orders suddenly, the supplier can be stuck with excess inventory, unused capacity, and financial stress. The more concentrated the revenue, the sharper this mismatch can be, which is why customer concentration is a classic risk factor. Another challenge is that Nvidia's top customers sometimes act as intermediaries rather than end users. So changes in actual demand can show up suddenly when these distributors adjust their stock levels. This can make forecasting difficult, as what seem like strong order backlogs can quickly turn into declining orders, causing bigger swings in revenue than expected. Lastly, Nvidia isn't just facing competition from other GPU makers. The real threat comes from vertically integrated platforms like Azure with Maya, Google Cloud with TPU, and AWS with Inferentia and Trainium. These platforms don't necessarily need the best raw performance. They compete on total cost, integration, and availability, which can put significant pressure on Nvidia's market position. Nvidia's cash flow is indeed impressive, but it's important to understand the nuances behind it. The core issue is that much of this cash flow depends on a small number of key customers, which makes it concentrated and potentially vulnerable. These large customers are not passive, they are actively exploring and investing in alternative technologies, which means this reliance is being challenged strategically. Because of this concentration and competitive pressure, Nvidia's cash flow is less diversified than many might assume. If even one or two of these big customers were to reduce their purchases significantly, the effect on cash flow could be sudden and sharp, rather than gradual. This risk is especially relevant, given that the market currently expects continuous acceleration these hyperscalers. So any slowdown could have an outsized impact. Nvidia's impressive cash flow in the AI era looks like clear evidence of market dominance, but dominance doesn't always mean stability. When most of the revenue depends heavily on just a few major customers, and those customers are developing their own in-house chips to cut down on reliance, the cash flow becomes fragile rather than well diversified. This means the same concentration that made Nvidia's growth soar can also cause it to fall sharply under the wrong circumstances. The risk isn't that Nvidia lacks a competitive advantage. Rather, it's that its strong cash flow depends on a small number of large customers, and those customers are steadily replacing Nvidia's products with their own designs. The fact that two customers accounted for nearly 40% of revenue in a single quarter is a clear warning sign. Big players like Microsoft, Google, AWS, and Meta are all actively building their own silicon platforms, which over time reduces their dependence on a single vendor like Nvidia. So, while Nvidia's cash flow may be large, if it increasingly comes from a few hyperscalers renting rather than owning the technology, this cash flow is vulnerable and strategically fragile. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.